Support and resistance represent key turning points where the forces of sellers or supply and buyers or demand meet. In the financial markets, prices are driven down by increasing supply and up by increasing demand. When supply and demand are equal, prices move sideways or range as bulls and bears slug it out for control. Support is the price level at which demand is thought to be strong enough to prevent the price from declining further. The logic dictates that as the price declines towards a support level and gets cheaper, buyers become more inclined to buy and sellers become less inclined to sell. By the time the price reaches the support level, it's believed that demand will overcome supply and prevent the price from falling through support, like you can see here, here, and here. Let's define in general terms how a price level can become support. When prices fall to a new low and then rally, buyers who missed out on the chance to buy at the new low will be inclined to come into the market and buy if the price returns to that level again. Afraid of missing out for a second time, they may enter the market in sufficient numbers around the previous low to take control of the market away from sellers. The result will be another rally around that same price level, reinforcing perceptions that price is unlikely to fall beyond that level, thus creating what we call support. A decline below support indicates a new willingness of sellers to come in and sell at even lower prices, and/or a lack of incentive to buy. Once support is broken, another support level will be established at some time in the future, but at a lower price. In a range-bound market, support lines typically establish themselves as horizontal lines like you can see here. But in a trending market, you can also see that a trend line offers support and resistance to price action as well. Resistance, similar to support, is the price level at which selling is thought to be strong enough to prevent the price from rising further. And the logic dictates that as the price advances towards resistance, sellers become more inclined to sell and buyers become less inclined to buy. By the time the price reaches the resistance level, it's believed that supply will overcome demand and prevent the price from rising above resistance, like you can see here in this example. Now let's define in general terms how a price level can become resistance. When prices rise to a new high and then sell off, sellers who missed out on the chance to sell at the new high will be inclined to come into the market and sell if the price level reaches that again. Afraid of missing out for a second time, they may enter the market in sufficient numbers around the previous high to take control of the market away from buyers. The result will be another sell, reinforcing perceptions that price is unlikely to rise beyond that level, thus creating the resistance level. As prices rise above resistance, this indicates a new willingness to buy at even higher prices and/or a lack of incentive to sell. Once resistance is broken, another resistance level will be established at some time in the future, but at a higher price level. With this basic introduction, it's probably pretty easy to see how beneficial an understanding of support and resistance can be in your trading. Traders who accurately recognize strong support and resistance levels often do much better at locating trading opportunities, and often have more confidence in how to manage their trades, i.e. where to set their stops and limits. In range-bound markets, support and resistance typically defines the outer bands of the range, while in trending markets, a trend line often provides support and resistance to price action as well. Before going into two specific ways to trade with support and resistance, we've got one more thing to cover. Because technical analysis is not defined as an exact science, it's sometimes useful to create support and resistance zones. Each pair has its own characteristics, and the analysis should reflect the intricacies of the pair. Sometimes exact support and resistance levels are best, and sometimes zones work better. Generally, the tighter the range, the more exact the level. If the trading range spans less than 2 months, and the price range is relatively tight, then more exact support and resistance levels are probably best suited. If a trading range spans many months and the price range is relatively large, then it's probably best to use support and resistance zones. These are only meant as guidelines, and each trading range should be judged on its own merits. Now let's talk specifically about how to locate trading opportunities with support and resistance. Anytime we teach a trading strategy or market approach, we start by stating the following. When looking for a potential buying opportunity, first note a pullback down to support when the market is in an uptrend, and look to buy near that support level. When looking for a potential selling opportunity, first look for a rally up to resistance when the market is in a downtrend, and look to sell near the resistance level. We rely very heavily on this principle, trade in the direction of the trend, and buy at support and sell at resistance. Again, this is the preface to everything we teach. So let's get started. Step 1. Locate the direction of the trend. This is a daily chart of the Aussie dollar, and it's quite clear that the market's in an uptrend. Therefore, we're going to be looking for buying opportunities. We can see here that price action reaches a new low within this uptrend, but after reaching this new low, price action changes direction and resumes its upward trajectory. At this time, we can go ahead and draw a trend line, and we're now going to look for this trend line to provide support to price action. Moving forward in time, we get what we're looking for. Price action falls again to our trend line. After waiting for a candle to close blue, confirming that prices have again begun their upward trajectory, we can buy at the open of the next candle here. Because this trend line appears to be acting as strong support, it makes sense to set our stop just beyond the trend line. If it doesn't hold and prices break through and continue downward, we wouldn't want to be in a buy position. Therefore, placing our stop around somewhere in this area here, just beyond the trend line, often makes sense. To further expand on why this makes sense, let's talk about another principle of technical analysis, which stipulates that support can turn into resistance and vice versa. Once the price breaks below the support level, the broken support level can turn into resistance. The break of support signals that the forces of supply have overcome the forces of demand. Therefore, if the price returns to this level, there's likely to be an increase in supply and hence resistance. On the flip side, we have resistance turning into support. As the price advances above resistance, it signals changes in supply and demand. The breakout above resistance proves that the forces of demand have overwhelmed the forces of supply. If the price returns to this level, there's likely to be an increase in demand and support will be found. The second principle has led some traders to work with breakout strategies, which we'll discuss in more detail now. Another way to use support and resistance is to trade outside of the range, in other words, to anticipate the breakout. This involves placing orders to buy above resistance and to sell below support. The rationale is that the market will gain momentum once it breaks out of the range, and thus by placing orders just below or above support and resistance, traders may be able to make big gains when the market moves out of the range. Momentum trading is a bit counterintuitive, as it involves buying at a higher price and selling at a lower price, but it can provide for some nice trading opportunities if it's timed correctly. Below is a chart that illustrates the concept of momentum trading. As we go back and look over time, we can see that prices touch this level several times, only to reverse course and sell off. So with a breakout strategy, we can set our buy entry just above this resistance level. If price action does break through the resistance level, like it has here, our entry order will trigger. As we mentioned previously, this resistance level will most likely now turn into support, so we can place our stop just below this level here. If prices fall back below the level, we might assume that the breakout was only a false breakout, and we don't want to be in a buy position, so our stop really will be in a good place here. Note how the price does accelerate once it breaks out of this range, and it looks like we're off to a good trade. Many traders' entire approach can be designed around the use of support and resistance. They believe that this is the most valuable piece of technical information that can be used in trading. Since many traders buy a move down to support in an uptrend, or sell a rally up to resistance in a downtrend, and then use those same levels to place their protective stops, it's not hard to understand why this concept is so important. This concludes our video on support and resistance. We appreciate you taking the time to watch this video, and good luck with your trading.